Welcome back, Kyle. Kyle's in charge of charitable giving at Fidelity Investments. Kyle and I are going to talk a little bit more about how the interest rate environment changing impacts charitable giving. And so for those of you watching, today's October 3rd when we're recording this. So if you notice, interest rates have been increasing for a while. And the function of interest rate increasing is really inflation, right? So the Fed's trying to fight inflation. How they do that is by raising interest rates. How they also do that is by quantitative tightening. And October 3rd marks the first day of real quantitative tightening. So we could see interest rates continue to go up. Anything can happen in the future, but we're saying like the trend is that it's going to continue to increase. Specifically, when we look at inflation, right? Inflation being the CPI, 35% of it comes from shelter. Shelter continues to remain high. And the shelter component is actual rentals. And rentals, they use this equation, and it's running around 6%. So if you take 6%, take 35% of that, you get 2 something. And that's the Fed's long-term objective. But that means everything else has to be zero for that to be true. So we know that the Fed will continue to raise interest rates, and that will also cause a higher interest rate environment. And how does that, Kyle, impact charitable giving? So I think there's 2 main strategies that you want to discuss, right?
Exactly. And we're looking at really 2 very popular charitable trusts that are used in the estate planning world. So the first of which being the Charitable Remainder Trust, that provides donors with a partial tax deduction up front when they fund it. They can provide themselves an income stream during the life of the trust or other income beneficiaries. And then the real charitable giving happens when the trust is over, usually after 20 years or their lifetime, whatever usually comes first. So there's that. And then there's a charitable lead trust, which is basically the inverse. And that allows a donor, similar situation, partial tax deduction. Income stream goes to the charities during their lifetime, but it's a really effective way to pass assets down to the next generation that are removed from the estate after they go into the charitable lead trust. Now, what's really interesting is that over the last couple of years, we've seen interest rates at very low numbers, right? So these the IRS every month publishes what's called the 75/20 rate, which is basically used to calculate the tax deduction of both of these vehicles. It's part of the formula. So with low interest rates, charitable lead trusts are great vehicles to fund because the tax benefits up front to the donor are a lot greater. And then the inverse applies. As this interest rate environment has really gone the last 6 months, we've seen interest rate hikes pretty often. And now charitable remainder trusts become a lot more beneficial because of that upfront tax deduction. So it's really important to know, and like at the end of the day, talk to your estate planning attorney about these different vehicles, but understand the atmosphere and the environment we're in make it a lot more conducive for charitable remainder trusts.
Yeah, absolutely. And I think like as interest rates go up, the consideration is also the 75/20, the IRS rate. Giving to family members, that becomes less advantageous because those rates were so low a while back that you'd be silly not to give within loans within families. And then this rate, as it goes up, that directly impacts the charitable giving piece because now you have a higher threshold calculation.
Exactly.
Yeah. So what else about the interest rate should we be watching if we're charitably inclined? What are the alternative options?
Yeah, I mean, I think right now you're looking at any type of income generating charitable vehicles. So like charitable remainder trusts, a lot of nonprofits put together charitable gift annuities, which are sort of very, very similar in context. But yeah, anything that provides income back to the donor, that 75/20 rate is super impactful. But yeah, like the charitable lead trusts and vehicles that sort of defer or rather have the giving happen during current day and defer the income or the end benefit back to the donor or their family member is probably worth avoiding in this current rate.
Yeah, so with the interest rates high, you want that income to come back to you, right? Is essentially what we're hearing here. So if you're charitably inclined and you're looking for strategies that make sense for your specific situation and you have questions, please reach out to us. You can visit our website at clientfirstcap.com and you can reach out. All our contact information is there. But thank you for watching. Kyle, thank you for your time. And until next time.
Thanks, Amar.